Hi everybody, and welcome back to video number 2 in chapter 19. And when we left off, we were looking at the overfunded or underfunded status measured as the difference between fair value of the plan assets and the projected benefit obligation. Okay, so here's an illustration. The Coker Company has a projected benefit obligation of $300,000. The fair value of its plan assets is $200,000. So what is the funded status of Coker's pension plan? Well, pretty easy to figure here. The funded status is $90,000, and that's with a credit balance. That means that the plan is underfunded here, and Coker therefore reports a pension liability on its balance sheet. If instead the fair value of Coker's plan assets were $430,000, it would report a pension asset of $130,000. The difference between $430,000 and $300,000. Several components are involved in pension expense. The first one is service cost here, and that is an expense caused by the increase in pension benefits, the projected benefit obligation, to employees because of their services rendered during the current year. Actuaries compute service cost as the present value of the new benefits earned by employees during the year. The second here, interest on the liability. Because a pension is a deferred compensation arrangement, there is a time value of money factor. As a result, companies record the pension liability on a discounted basis. Interest expense accrues each year on the projected benefit obligation, just as it does on any discounted debt. So the actuary helps to select the interest rate, referred to as the settlement rate. Number 3, actual return on the planned assets. The return is earned by the accumulated pension fund assets in a particular year and is relevant in measuring the net cost to the employer of sponsoring an employee pension plan. Therefore, a company should adjust annual pension expense for interest and dividends that accumulate within the fund, as well as increases and decreases in the fair value of the fund assets. Number 4, the amortization of prior service cost. Pension plan amendments, including initiation of a pension plan, often include provisions to increase benefits or, on rare occasions, to decrease benefits for employee service provided in prior years. The company grants plan amendments with the expectation that it will realize economic benefits in future periods. Thus, it allocates the cost, that's prior service cost, of providing these retroactive benefits to pension expense in the future, specifically to the remaining service years of the affected employees. And finally, gain or loss. Volatility in pension expense can result from sudden and large changes in the fair value of plan assets, resulting in differences between the actual return and the expected return on plan assets, and by changes in projected benefit obligation. We will discuss these complex computations later in this chapter. So if we look at these components, here is the service cost for the year. That generally is going to increase the pension expense. The interest on the liability increases the pension expense. The actual return on planned assets, however, generally decrease pension expense. The gain or loss can decrease or increase pension expense. And finally, the amortization of prior service costs generally increases pension expense. Okay, let's go through each of these components. The service cost is the actuarial present value of benefits attributed by the pension benefit formula to employee service during the period. So number one here, the actuary predicts the additional benefits that an employer must pay under the plan's benefit formula as a result of the employee's current year service. Then number two, the actuary discounts the cost of those future benefits back to their present value to determine service cost. Interest on liability here. The second component of pension expense is interest on the liability or interest expense. The interest component is the interest for the periods on the projected benefit obligation outstanding during the period. Companies determine the interest rate to apply to the pension liability by looking at the rates of return on high quality fixed income investments currently available, whose cash flows match the timing and amount of the expected benefit payments. All right, the next component is the actual return on plan assets. And pension plan assets are usually investments in stocks, bonds, and other securities and real estate that a company holds to earn a reasonable return, generally at minimum risk. So, what activities increase or decrease the balance of plan assets? Here, number one, employer contributions. When the employer contributes funds to the plan assets on behalf of the employees, the balance in the plan assets will increase. And number two, the actual return on plan assets. The investments in stocks, bonds, and other securities that generate a return in the form of dividends, interest, and changes in fair value. So, what is that actual return on plan assets? The benefits paid. Employees who are currently retired receive benefit plan paid from the plan assets. Therefore, benefit payments decrease the balance of the plan assets. Okay, the equation used to compute actual return. The companies compute the actual return by adjusting the change in the plan assets for the effects of contributions during the year and benefits paid during the year. The following contribution can be used to compute the actual return. So the actual return is, we'll start with plan assets ending balance, subtract the plan assets beginning balance, then subtract contributions and add the benefits paid to get to our actual return. So here's an illustration from the Munich's Incorporated, and it had the following data. Here's the fair value of plan assets at the beginning of the year, the fair value of the plan assets at the end of the year, the contributions to the plan during the year, and the benefits paid during the year. So we simply plug these numbers into the previous slide formula to determine what the actual return on the plan assets for the year would be. So we start with the fair value of the plan assets at the end of the year, here, subtract out the fair value of the plan assets at the beginning of the year, here, and that gives us the increase in the fair value of the plan assets, $800,000. Then we deduct the contributions to the plan during the year, given here, and add the benefits paid during the year, given here. And so the actual return on planned assets totals $600,000. Now, Mayhew has the following information, and it has the same information that we just had in the prior slide, but it also has projected benefit obligation at the end of the year, accumulated benefit obligation at the end of the year, service cost for the year, and interest on January 1, the beginning of the year, for the projected benefit obligation. They want you to determine alpha, actual return on planned pension assets, Bravo, pension expense, and Charlie, the funded status of the pension plan. So let's look at alpha, the actual return on pension assets. And here it is. We're going to take the fair value of the plan assets at the end of the year, subtract out the fair value of the plan assets at the beginning of the year, and that gives us our increase in fair value of the plan assets. We'll deduct out the contributions, and we'll add in the benefits paid, and that gives us our actual return on plan assets for 2025 of $395,000. For Bravo, we are going to calculate the pension expense, and we do that by starting with the service cost, and we will add the interest on the liability and subtract out the actual return on assets, which we calculated under alpha here. And that gives us our pension expense of $52,000. Then under Charlie, we'll take a look at the funded status of the pension plan, and we start with the projected benefit obligation. We will back out the fair value of the pension plan assets, and we find that we have a underfunded status of the plan of $12,000. Mayhew's, therefore, is going to report a pension liability of $12,000 on its balance sheet. All right, we'll shift gears here and use a worksheet for the employer's pension plan entries. And here our columns include the items, the annual pension expense, the cash, and the pension asset liability. Then in memo form here in light green, we have the pension or the projected benefit obligation and the plan assets. So for bullet point 1, the general journal entries here, columns of the worksheet, determine the entries to record in the formal general ledger accounts. Bullet point number 2, the memo record here, columns on the right side, maintain balances in the projected benefit obligation and plan assets. And then bullet point number 3, the difference between the projected benefit obligation here and the fair value of the plan assets is the pension asset / liability, which is reported on the balance sheet. So remember the following 2 items. 1, if the pension benefit obligation is greater than plan assets, then you've got a pension liability, like we had in the prior slide. But number 2, if the pension benefit obligation is less than the plan assets, then we have a pension asset. That looks like a good place for us to stop this video, and when we return, we'll take a look at the Zarro Company. Until that time, bye for now.